This is video number 5, and we're going to call this Investing in a Business. This is a very important lesson because, as we saw at the end of last month, a student prepared a monthly budget, and in that budget, recall that the student ended up the month with $200 in cash. It had an iPhone. The student had an iPhone, which we valued at also $200. It had a laptop. The student had a laptop worth $800. A car worth $6,000. And household effects, which we valued at $2,000. The student also had liabilities at the end of the month. It had no credit card payable because, remember, that credit card payable, we paid it off last month, as a good student should. Also, the student loan, we still owed that, so the student still has a debt on the books of $3,000. And the net worth of the student, or the equity for the student at the end of the month, was $6,200. Again, let's verify. Things owned, assets, we add them all up, has to equal our debts owed plus our equity. And we see that our assets are worth, if you add those up, will be worth $9,200. Our debts are worth $3,000, so our equity is $6,200. Now, in this lesson, the student only has $200 in cash, but he would like to start his own business someday by buying a bicycle shop. But of course, with only $200, there's no way he can start the business. But today, on the very first day of the new month, as the student bikes home, he buys a $5 lottery ticket and takes $5 out of the bank and subtracts $5 from equity. We would call this gambling expense or lottery expense. And lo and behold, the student wins $50,000. Cash up, net worth up. Now the student is able to finance the very first cash flow for the business. So the student takes, of that $50,000, the student spends $40,000, and we're going to have to create a brand new asset. Let's put this asset up here called Investment in Bike Business. And we would add that as an asset right here. Cash would go down, investment in bike business, a new asset would go up. Now check this out. When we open up a brand new business account, by subtracting from our personal account, we will open up a brand new business entity. And that business entity would have a brand new set of accounts. And the first account for the business would be cash of $40,000. And the business's equity would go up $40,000. This contributed equity from the owner, we'll call this contributed equity. What has happened here, folks, is the student now has secured the financing to start the bike business. And the student puts $40,000 in the business account, add to cash. We got to make sure our assets equal liabilities plus equity. And so assets $40,000 went up, equity $40,000 went up, we balance. So now this video shows that when a an individual wants to start a business, they first must get the cash in order to finance their business. The very first entry for most businesses is to add to the business cash account, add to the equity, and many books call this the owner's investment. But really, from the owner's personal activity here, this $50,000 is a personal investing activity. I denote that with an I. But the inflow of cash to the business is a financing activity. And later on, we'll call that a F activity, a financing activity. This ends our 5th video called Investing in a Business.